It happened again, just a few weeks ago. Bitcoin was climbing. The numbers on the screen were green. Everything seemed fine. Investors felt a familiar warmth, the kind of warmth that comes with confidence. It felt like the market was finally behaving. It was a steady, predictable ascent. People were checking their phones less often. They were sleeping better at night. The usual chaos of the crypto world seemed to be taking a break. It was a calm sea, and the boats were rising with the tide. This, they thought, is what a mature asset looks like. This is what stability feels like. But they were wrong. Then the drop came. It was sudden. It was sharp. It was a digital cliff. In a matter of hours, billions of dollars vanished. The green numbers turned a violent red. The calm sea became a storm. Phones started buzzing with alerts. News headlines screamed of a crash. Panic began to ripple through the market. People who were confident just yesterday were now filled with dread. They scrambled to understand what had happened. Was there a major government announcement? Did a large company sell its holdings? Was there a security breach on a major exchange? Everyone was looking for a reason, a logical explanation, but there wasn't one, not a clear one anyway. The news was quiet. There was no single catastrophic event. There was no rational trigger for such a massive sell-off. The explanations that trickled out felt weak. They were whispers and rumors, a tweet from a minor influencer, a small regulatory change in a distant country, a technical indicator that a few traders were watching. None of it seemed big enough. None of it justified the sheer scale of the collapse. Billions of dollars in value had been erased from the world, and nobody could point to the real reason why. This is the puzzle of Bitcoin. It's a market that moves with incredible force, but often without a clear cause. It isn't like the stock market. When a company's stock plummets, you can usually find the story. A bad earnings report, a failed product launch, a scandal in the executive suite. There is a cause and an effect. With Bitcoin, the effect is gigantic. It's a tidal wave of financial change. But the cause is often a mystery. It's like watching a giant fall over, but you can't see what tripped him. The event is real, but the trigger is invisible. We spend a lot of time analyzing the what. We track the price. We draw lines on charts. We build complex models to predict the next move. We talk about support levels and resistance zones. We discuss moving averages and trading volumes. This is the world of technical analysis. It's a world of numbers and patterns. It assumes that the market is a machine that follows certain rules. If we can just understand the rules, we think, we can understand the machine. We can predict its behavior. We can know when to buy and when to sell. But what if we are looking in the wrong place? What if the market isn't a machine at all? What if it's something else entirely? A machine is predictable. Its parts move in a logical sequence. But the Bitcoin market often feels illogical. It feels emotional. It has good days and bad days. It gets excited and it gets scared. It seems to have a personality. It's moody. It's unpredictable. Thinking of it as a simple machine, a collection of data points and trend lines, feels incomplete. It misses the most interesting part of the story. Maybe the key isn't in the charts. Maybe it's in us, in the people who are buying and selling. We are the ones pushing the buttons. We are the ones making the decisions. Every single trade, big or small, starts with a human choice. A choice to click buy or a choice to click sell. These choices are not always rational. They are driven by hope. They are driven by fear. They are influenced by the people around us. They are shaped by the stories we tell ourselves. We are not robots, calculating probabilities. We are human beings, navigating a world of uncertainty. So, this is the real question. It's not about predicting the next price swing. It's about understanding it. What is happening inside our minds when we see the price of Bitcoin shoot up? What deep, ancient parts of our brain take over when we see it crash? Why do we all seem to rush for the exits at the same time? To understand why Bitcoin whipsaws with such incredible violence, we have to look away from the screen. We have to look inward. We need to expose the hidden psychological forces, the investor mindset, that turns a digital currency into a billion-dollar roller coaster. Table of Contents. Part 2. Act 1. Herds and Stories, about 6 sections. Section 1. The Digital Campfire. Section 2. The Siren Song of the Influencer. Section 3. A Story of Inevitable Riches. Section 4. The Echo of the Crowd. Section 5. When the Narrative Flips. Section 6. The Cascade of Fear. Humans have always gathered around campfires. Humans have always gathered around campfires. We have done this for thousands of years. Around the fire, we share stories. We share information. We decide what is safe and what is dangerous. A rustle in the bushes becomes a story about a predator. A strange light in the sky becomes a tale of the gods. These stories help us make sense of a confusing world. They give us a shared map. They tell us how to act. Our survival once depended on listening to the stories told by our tribe. We learned to trust the group. The group's wisdom kept us alive. It was a fundamental human instinct. Today, the campfire is digital. It's not a physical fire in the middle of a village. It's Twitter, it's Reddit, it's Telegram, it's Discord. These are the places where the modern tribe gathers. We scroll through feeds instead of listening to an elder. We read posts. We watch videos. But the core function is the same. We are looking for information. We are trying to understand the world. And in the world of crypto, the digital campfire is always burning. It is where the stories about Bitcoin are created. It is where the stories about Bitcoin are shared. It is where the stories about Bitcoin are amplified. It's where a new kind of group wisdom is formed, minute by minute. This digital gathering has a powerful effect on our minds. When we see thousands of people online sharing the same idea, it feels true. It feels important. This is a psychological principle called social proof. We assume that if many people are doing something, it must be the right thing to do. If everyone at the campfire says a certain berry is safe to eat, you are likely to eat it. You don't go out and test it yourself. You trust the herd. In the crypto market, if thousands of anonymous accounts are saying buy, our brains interpret that as a strong signal of safety and opportunity. This is where the rationality of the market begins to break down. The stories told around the digital campfire are not always based on facts. They are often based on emotion. They are based on hope. They are based on excitement. A small piece of good news can be exaggerated into a world-changing event. A minor rumor can become an undeniable truth. The logic doesn't matter as much as the consensus. The power of the story comes from how many people believe it. And in the fast-paced, interconnected world of crypto, a story can spread to millions in just a few hours, creating a powerful current that is difficult to resist. In ancient myths, sailors had to resist the sirens. These creatures sang beautiful songs from rocky islands. Their music was so enchanting that it lured sailors to their doom. The sailors would crash their ships on the rocks, mesmerized by the sound. The song promised them everything they desired. Today, the crypto market has its own sirens. They are the influencers. They are the celebrities. They are the tech billionaires with millions of followers. They don't sing from rocky islands. They post on social media, but their message can be just as hypnotic, and it can be just as dangerous for an unprepared investor. When a famous entrepreneur tweets about Bitcoin, it is not just a piece of information. It's a powerful signal. It's a song that cuts through the noise. This person is successful. They are wealthy. They are admired. Our brains create a simple shortcut. We think, if this smart, rich person believes in Bitcoin, then it must be a good investment. We don't necessarily analyze their argument. We don't check their data. We are drawn in by their status. Their endorsement feels like a secret tip from someone who knows the future. It's a powerful validation that makes us feel secure in our own beliefs. This effect is magnified by the sheer scale of their audience. A single tweet can be seen by tens of millions of people in an instant. It creates an immediate, coordinated wave of interest. Exchanges see a sudden spike in new accounts. Trading volumes surge. The price begins to move. People who were on the sidelines, hesitant to invest, suddenly feel a powerful urge to join. This is the fear of missing out, ignited by a trusted voice. The influencer's song makes it seem like the ship to riches is leaving the dock right now. You have to get on board, or you will be left behind forever. The problem is that these sirens are not always singing for our benefit. Sometimes they are singing for their own. They may have a large personal investment in the assets they promote. Their public enthusiasm can drive up the price, increasing their own wealth. Other times, they might simply be caught up in the same excitement as everyone else. They are not immune to the psychological forces of the market. They might genuinely believe the story they are telling, but whether their intentions are pure or not, the effect is the same. They act as a powerful magnet, pulling the herd in a single direction. Every powerful movement needs a great story, a narrative that is simple, compelling, and easy to share. For much of Bitcoin's history, that story has been one of inevitable riches. It goes something like this. Bitcoin is a revolutionary technology. It is a new form of money, free from the control of governments and banks. There is a limited supply. Only 21 million Bitcoin will ever exist. As more and more people realize its value, the price must go up. It's not a matter of if, but when. Buying Bitcoin is not just an investment. It is securing your place in the future of finance. It is an opportunity of a lifetime. This narrative is incredibly powerful. It transforms a complex financial asset into a simple, heroic tale. Bitcoin is the underdog hero, fighting against a corrupt and outdated system. The early adopters are the wise visionaries. The people who buy in now are still early to the revolution. The story provides a clear enemy, the traditional financial system, and it provides a clear goal, financial freedom. This narrative doesn't require you to understand blockchain technology. It doesn't require you to analyze market dynamics. It just requires you to believe in the story. And it is a very easy story to believe. The story of inevitable riches works because it taps into deep human desires. We all want a better future. We want security. We want to feel like we are part of something big and important. The Bitcoin narrative promises all of these things. It offers a shortcut to wealth. It offers a sense of belonging to a community of forward thinkers. It makes investors feel smart, like they have discovered a secret that the rest of the world has yet to understand. This feeling is intoxicating. It makes it easy to ignore risks and dismiss any information that contradicts the story. This is how a bubble is built. It is built on a foundation of a good story. As the price goes up, the story seems more and more true. The rising price becomes the proof that the narrative is correct. This creates a feedback loop. The story drives the price up, and the rising price reinforces the story. New investors are drawn in, not by a sober analysis of the asset, but by the magnetic pull of the narrative. They hear the story from friends. They see it on social media. They see the price charts going up and to the right. And they think, the story must be true. Imagine you are in a large, empty room. You shout a word. A moment later, you hear the echo. Now imagine a stadium filled with thousands of people. One person starts a chant. People nearby slowly join. The next section joins. Within a minute, the whole stadium chants in unison. The sound is deafening. It feels like a single, powerful voice. This is what happens in the crypto market. The stadium is the internet. The chant is market sentiment. It is the collective feeling of buy-sell, driven by our deep-seated need to conform. We are social creatures. We feel safety and comfort when beliefs align with the group. Seeing a dominant opinion online creates pressure to agree. Dissent feels uncomfortable. It feels risky. What if the crowd is right and we are wrong? Pressure is strongest in uncertainty. Crypto is the definition of uncertainty. No one knows what price will do next. So we look to the crowd for clues. Social media platforms amplify this effect. They are echo chambers, sound waves bouncing between hundreds of small, anonymous avatars, growing larger and more intense with each bounce. Algorithms surface content they'll think we'll like. They show posts from people we already agree with. If you're optimistic, positive news, bullish predictions, success stories. If you're pessimistic, warnings, crash, prediction stories of loss. This distorts reality. It makes it seem like everyone thinks like you. It strengthens your conviction and blocks alternatives. The echo chamber creates a powerful consensus, but it's fragile. Built on recycled opinions, not independent thought. Everyone listens to everyone else's echo. When market rises, bullish sentiment overwhelms. Doubts are shouted down or filtered out. Optimism feels like unshakable truth. When sentiment shifts, it can shift very quickly. Echo chamber amplifies fear-greed. The chant of buy can become a panicked scream of sell in an instant. Stories are not set in stone. They can change. A hero can become a villain. A story of hope can become a story of fear. In the crypto market, the dominant narrative can flip with breathtaking speed. The story of inevitable riches is powerful when the price is going up. Every green candle on the chart is another chapter confirming the tale. But when the market turns, that same narrative suddenly looks fragile. It looks naive. A sharp price drop introduces a new and uncomfortable character into the story. Doubt. And doubt is a powerful force. Suddenly, the old story doesn't fit the facts on the screen. The promise of inevitable gains is broken by the reality of sudden losses. Investors who felt like geniuses just a week ago now feel like fools. They start to question everything. Was the story ever really true? Was it all just hype? This is when a new narrative begins to emerge. It often starts as a whisper, a critical article from a respected news source, a warning from a well-known economist, a government official mentioning the word regulation. These whispers start to spread around the digital campfire. The new story is the dark twin of the old one. It is a narrative of danger and collapse. In this version of the tale, Bitcoin is not a revolution. It is a bubble. It is a speculative frenzy with no real value. The early adopters were not visionaries. They were just lucky. The governments are not outdated. They are powerful, and they are about to crack down. This story of doom is just as simple and compelling as the story of riches. It taps into our deep-seated fear of loss. It offers a simple explanation for the pain of watching your investment shrink. It wasn't your fault. You were caught in a scam. As this new narrative gains traction, it creates its own feedback loop. The story of doom causes people to sell. The selling pushes the price down further. The falling price is then seen as proof that the doom narrative is correct. This convinces more people to sell. The echo chamber that once amplified greed now amplifies fear. The same influencers who were promising a trip to the moon are now silent, or they are posting charts with downward-pointing arrows. The entire emotional landscape of the market has been inverted. The shared dream has become a shared nightmare. When a few animals in a herd get spooked, they start to run. Their panic is contagious. Other animals see them running and start running too, even if they haven't seen the danger themselves. They are reacting to the fear of the group. Soon, the entire herd is stampeding. This is a cascade. A small initial event triggers a chain reaction that grows exponentially. In the Bitcoin market, a narrative flip can trigger a financial stampede. A few large sellers, or a piece of bad news, can spook the first line of investors. Their selling creates the initial panic. This is where the structure of the modern market adds fuel to the fire. Many traders use automated systems. They set stop-loss orders. These are instructions to automatically sell their holdings if the price drops to a certain level. When the first wave of selling pushes the price down, it starts to trigger these automated orders. This creates a second wave of selling. This new selling pressure pushes the price down even further, triggering even more stop-loss orders that were set at lower levels. It is a domino effect. Each falling price triggers the next wave of selling, creating a self-reinforcing cascade. At the same time, human traders are watching this happen in real time. They see the terrifying red candles on their screens. They see the price falling off a cliff. Their rational minds shut down. The ancient emotional parts of their brain take over. The instinct is not to analyze. The instinct is to escape. They join the stampede. They sell, not because of a change in the fundamental value of Bitcoin, but because everyone else is selling. They are running with the herd. The fear of being the last one holding the bag is overwhelming. It is a pure, primal reaction to perceived danger. This is how billions of dollars can be wiped out in a matter of hours. It is not a rational, calculated reevaluation of the asset. It is a psychological cascade. It starts with a story that flips from hope to fear. This flip spooks the first investors. Their selling triggers automated systems. This automated selling creates a visible price crash. The crash causes widespread panic among human investors. They join the sell-off, pushing the price down even further. It is a perfect storm of social proof, narrative collapse, and automated triggers. It is the herd in full stampede, and it is one of the most powerful and destructive forces in all of finance. Imagine, I offer you a simple bet. I'll flip a coin. If it's heads, I give you $1,000. If it's tails, you give me $1,000. It's a perfectly fair 50-50 chance. Do you take the bet? Most people won't. The reason is simple, yet profound: the pain of losing $1,000. It feels much stronger than the pleasure of gaining $1,000. This isn't a sign of weakness. It's a fundamental feature of the human mind. Psychologists call this loss aversion. The sting of a loss is roughly twice as powerful. It eclipses the joy of an equivalent gain. Our brains are wired to protect what we have, more than they are wired to seek out more. This bias plays a huge role in the turbulent world of Bitcoin. When the price is climbing, investors feel good, quiet satisfaction, not ecstatic joy. But when the price starts to fall, the reaction is immediate and intense. A 10% drop feels far bigger than a 10% gain. It triggers alarm bells in our brains. Not just disappointment, a visceral sense of danger. It feels like something is being stolen from you. This asymmetry fuels market volatility. We overreact to negative news and price drops. Think of the investor who bought at a high. As the market dips, loss aversion hits hard. Every red tick is a shot of psychological pain. The rational move: hold on, wait for recovery. Especially if your long-term belief hasn't changed. But the emotional pressure is immense. The primal urge: make the pain stop. And the way to stop it is to sell. Get out of the market. End the loss. Sell-offs can accelerate quickly. It's not just a strategy shift. It's a stampede away from pain. This explains panic selling, a sharp drop. You don't just see value decreasing. You imagine it going to zero. The fear of total loss becomes overwhelming. Loss aversion magnifies that fear. So people sell at the bottom, locking in losses. They aren't being coldly rational. They're reacting to a powerful bias, choosing a definite, smaller pain to avoid a terrifying, catastrophic one. We like to think of ourselves as open-minded. We believe we weigh all the evidence fairly before making a decision. But the reality is quite different. Our minds are more like lawyers than scientists. A scientist seeks the truth, wherever it leads. A lawyer starts with a conclusion: their client is innocent, and then finds evidence to support it. Our brains do the same thing. Once we form a belief, we subconsciously look for information that confirms it. We also tend to ignore or dismiss information that challenges it. This is called confirmation bias. We don't see the world as it is. We see it through a keyhole that shows us only the things we already believe. In the crypto world, confirmation bias is everywhere. If you have decided that Bitcoin is the future of finance, your mind will go to work finding proof. You will pay close attention to news about major companies adopting crypto. You will click on articles with headlines like "Why Bitcoin is headed to 100,000." You will find yourself drawn to influencers and communities that share your optimism. Every piece of positive news feels like a brilliant insight. It confirms your intelligence for getting into Bitcoin early. It reinforces the story you tell yourself about inevitable riches. Your view of the market becomes a self-curated highlight reel of positive reinforcement. Conversely, if you believe Bitcoin is a dangerous bubble, your confirmation bias will work in the opposite direction. You will notice every story about scams, hacks, and regulatory crackdowns. You will remember every prediction of a market crash. You will dismiss the stories of adoption as hype or misunderstanding. When the price goes up, you might see it as further proof of an irrational frenzy that is bound to end badly. The information you consume validates your skepticism, making you feel wise for staying away from the madness. You are, in effect, building a strong case for your initial conclusion, filtering out anything that might complicate your verdict. This bias helps explain why the crypto market is so polarized. It's not just a disagreement about facts, it's a disagreement about which facts matter. Both the bulls and the bears are living in their own self-constructed realities. They are looking at the same world, but through different keyholes. This is why market sentiment can feel so strong and unshakable. When everyone in your circle is confirming your belief, it feels like an objective truth. This makes it very hard for people to change their minds, even when faced with powerful counter-evidence. And it means that when the market does turn, the shift can be jarring, as one reality suddenly shatters and is replaced by another. Section 3. The first number you see. Imagine you are shopping for a new watch. The first one you see has a price tag of $5,000. It's beautiful, but way out of your budget. You keep looking. The next watch you see is priced at $500. Suddenly, this second watch seems incredibly cheap. It feels like a bargain. Now imagine you walked into a different store, and the first watch you saw was $50. In that context, the $500 watch would seem outrageously expensive. The watch itself didn't change, but your perception of its value did. This is the anchoring bias. The first piece of information we receive, the anchor, heavily influences all our subsequent judgments and decisions. The anchoring bias is a powerful force in the Bitcoin market. For many investors, the most powerful anchor is the all-time high price. Let's say Bitcoin reached a peak of 69,000. That number gets burned into the collective consciousness of the market. It becomes the reference point. When the price later drops to 30,000, many investors don't see an asset that has grown massively over the past few years. They see an asset that is on sale for more than 50% off its peak. The 69,000 anchor makes the current price seem cheap, creating a psychological incentive to buy. It frames the decision not as a risky speculation, but as a rational opportunity to get a discount. This bias works in the other direction as well. For someone who bought Bitcoin at 60,000, that purchase price becomes their personal anchor. If the price falls to 40,000, they are anchored to their entry point. The idea of selling at 40,000 feels like accepting a huge loss, so they hold on, hoping the price will return to their anchor point, allowing them to break even. This can lead to people holding on to a falling asset for far too long, refusing to sell because they are psychologically tied to the price they first paid. Their decision isn't based on the future potential of the asset, but on a number from the past. The anchoring effect contributes significantly to Bitcoin's whiplashes. When the price is falling, the all-time high anchor encourages a wave of buy-the-dip activity, which can slow the crash and create a rebound. Conversely, when the price is rising, people anchored to lower entry points might be tempted to sell too early to lock in what feels like a huge profit. These anchors create strong psychological zones of support and resistance that have little to do with technical analysis. They are the ghosts of old prices, haunting the minds of current investors and shaping their decisions in ways they rarely notice. Section 4. The ship that sailed without you. There is a unique kind of anxiety that is very common in the modern world. It is the feeling that other people are having more rewarding experiences than you are. You see pictures of your friends on vacation. You hear stories of a colleague's promotion. You see a long line outside a new restaurant. And you feel a pang of unease, a sense that you are being left behind. This is the fear of missing out, or FOMO. It's a powerful social anxiety, supercharged by social media, that pushes us to want what others have. It's the nagging feeling that the party is happening somewhere else, and you weren't invited. This fear can drive us to make impulsive decisions. In the world of cryptocurrency, FOMO is like a jet engine. It can propel prices to unimaginable heights. When Bitcoin starts a bull run, the stories begin to circulate. You see a news headline about a Bitcoin millionaire. Your friend mentions how much money they've made. You see charts on Twitter that only go up. The narrative is not just about money. It's about being part of a historic movement. It's about being smart. It's about being early. It's about being on the right side of the future. The feeling of FOMO starts to build. It feels like a ship to a distant, wonderful land is leaving the harbor, and everyone you know is getting on board. You know, this fear is not a rational calculation of risk and reward. It is a deeply emotional response. The logical part of your brain might be screaming about risk and volatility. It might be reminding you that you don't fully understand what you're buying. But the emotional pull of FOMO can be stronger. The fear of future regret, the thought of looking back in a year and thinking I could have been rich if only I had bought then, can be unbearable. So, people jump in. They buy at the peak. They wire money to exchanges without doing any real research. They are not investing. They are buying a ticket to stop the feeling of being left behind. FOMO is the primary driver of the most manic phases of a crypto bubble. It's what causes prices to go parabolic, rising almost vertically. The buying is no longer driven by fundamentals or even the original story. It's driven by the buying itself. People are buying because the price is going up, and they are afraid it will go up more without them. This creates a highly unstable market structure. The late-stage buyers, driven by the most intense FOMO, are the most skittish. They have no deep conviction. They are the first to sell at the first sign of trouble, which is why a FOMO-driven rally can collapse so dramatically. Section 5. The Gambler's Hope. Visit any casino and you will see a curious behavior at the roulette table. You might see a player who notices that the ball has landed on a red number 5 times in a row. They think, the next one must be black. It's due. They place a large bet on black. This is a classic error in judgment known as the gambler's fallacy. A hand rolls a pair of dice with up and down arrows on their faces, frozen in midair. It is the mistaken belief that if something happens more frequently than normal during a given period, it will happen less frequently in the future. In reality, each spin of the roulette wheel is an independent event. The ball has no memory. The odds of it landing on black are the same on every single spin. This same fallacy infects the minds of crypto traders. After a long and painful market crash, when Bitcoin's price has been falling for weeks, a trader might look at the chart and think, it has gone down so much, it has to go up soon. They feel like the market is due for a reversal. They start buying, believing they are getting in at the bottom. But the market, like the roulette wheel, has no obligation to fulfill their expectations. The past price action does not determine the future. There could be underlying reasons for the downtrend that have not yet been resolved. The market can continue to fall, defying the gambler's hope. The opposite is also true. During a powerful bull run, some traders might fall for the hot hand fallacy, which is the gambler's fallacy in reverse. This is the belief that a string of successful outcomes is likely to continue. They see the price of Bitcoin going up day after day and they think, it's on a hot streak, I have to stay in. They ignore warning signs and become overconfident, believing the trend will continue indefinitely. They feel like they can't lose. This leads them to take on excessive risk, perhaps by using leverage or investing more than they can afford to lose, believing the hot hand will last forever. These fallacies create predictable but irrational behaviors at market extremes. The gambler's fallacy encourages people to try to catch a falling knife, buying into a downtrend too early and suffering further losses. The hot hand fallacy encourages people to ride a bubble all the way to the top and then all the way down, blinded by overconfidence. Both biases stem from the same fundamental error. Our brains are desperate to find patterns and order, even in random or chaotic events. We impose a narrative of due-ness or streaks onto a system that is far more complex and unpredictable than we want to believe. Section 6. The Illusion of Control. Humans have a deep need to feel like they are in control of their own destiny. We don't like to admit that our success might be due to luck or chance. When something good happens, we tend to attribute it to our own skill and intelligence. When something bad happens, we often blame external factors or bad luck. This is the illusion of control. It's the tendency for people to overestimate their ability to influence events. It's why we press the elevator button multiple times, as if that will make it arrive faster. It's why we have lucky shirts. It's why we have rituals. We crave a sense of agency, even when we have none. In investing, this illusion is particularly strong. When a crypto trader makes a successful trade, they rarely attribute it to luck. They attribute it to their superior research. They attribute it to their brilliant chart analysis. They attribute it to their unique insight into the market. This is especially true in a bull market. When prices are rising across the board, it's easy to feel like a genius. Every decision seems to be the right one. The investor starts to believe they have a special talent for picking winners. They have cracked the code. This overconfidence leads them to take bigger and bigger risks, convinced that their skill will protect them. The tools of modern trading amplify this illusion. The sheer amount of data charts, technical indicators, can make an investor feel like a pilot in a sophisticated cockpit. They have dozens of screens and dials. They can draw trend lines, calculate moving averages, monitor trading volumes. All this activity creates a powerful feeling of control. It feels scientific, it feels professional. But the reality is that in a market driven by herd psychology and narrative, these technical tools can provide a false sense of precision. They can make you feel like you are steering the ship, when in fact you are just a passenger on a wave you cannot control. The illusion of control is a dangerous bias because it prevents us from learning from our mistakes. If we attribute all our successes to skill and all our failures to bad luck, then we never have to question our own strategy. When the market turns and the trader who felt like a genius loses a fortune, they don't think, "My strategy was flawed." They think, "The market was irrational." They think, "I was just unlucky." This prevents them from adapting and improving. It keeps them locked in a cycle of overconfidence during the good times and bewilderment during the bad times, never fully grasping the true role that chance and psychology play in their results. Section 1. The market's nervous system. So far, we have looked inside the mind of the individual investor. We have explored the stories we tell. We have examined the mental shortcuts, the biases that shape our decisions. But our minds do not operate in a vacuum. They are connected to a larger system, a structure. Think of it like a body. The individual psychology of traders, their fears, their hopes, are like the cells. But to understand how the body moves, how it jumps and twitches, you also need to understand the nervous system. You need to understand the pathways that carry signals from the brain to the muscles and how fast those signals travel. In the world of crypto, this nervous system is the market structure itself. This structure is different from anything that has come before. It is global. It is open 24 hours a day, 7 days a week. There is no opening bell to start the day. There is no closing bell to give everyone a chance to pause and reflect. The market never sleeps. This constant activity creates a unique kind of pressure. You can go to bed with a profit and wake up to a devastating loss. This relentless, non-stop nature of the market preys on our psychology. It encourages constant monitoring. It feeds our anxiety and our fear of missing out. It's a nervous system that is always switched on, always firing signals. Then there is the matter of leverage. On many crypto exchanges, traders can borrow money to make much larger bets than their own capital would allow. This is called trading with leverage. A trader might use a small amount of their own money to control a position 10 times larger, 50 times larger, 100 times larger. This acts as a massive amplifier for gains-losses. A small upward move in price can create enormous profits, but a small downward move can wipe out a trader's entire initial investment in an instant. This is called a liquidation. Leverage turns small market ripples into destructive tidal waves. This combination of a 24/7 market and easy access to high leverage creates an incredibly fragile system. It's a nervous system that is constantly on edge, flooded with adrenaline. A small piece of bad news, a minor dip in price, can trigger a chain reaction. Leveraged positions get liquidated. These forced liquidations are automatic sell orders, which push the price down further. This triggers more liquidations at lower price points. It's a cascade of forced selling that has nothing to do with long-term belief or fundamental value. It's the market's nervous system having a seizure, driven by the structural mechanics of leverage. Section 2. The logic of the machine. In this hyper-fast, always-on market, not all the traders are human. In fact, a huge portion of the trading volume comes from machines. These are algorithms, sophisticated computer programs designed to buy and sell assets at speeds that no human could ever match. These algorithms are not driven by fear or greed in the way we are. They don't get excited by a good story. They don't feel the sting of loss aversion. They are driven by pure, cold logic. They are programmed to identify patterns to react to specific technical signals and to execute trades in fractions of a second. They are the market's reflexes. Many of these algorithms are designed for what is called high-frequency trading. They make thousands of tiny trades every minute, trying to profit from very small price differences across different exchanges or over very short time frames. They are not investing in Bitcoin for the long term. They are simply reacting to the flow of data. If they detect a large wave of buy orders coming into the market, they might jump in front of that wave, buying an instant before and selling into the rising price. They are not creating the trend, but they are dramatically accelerating it. They are pouring gasoline on the fire of human emotion. This is where the structure of the market gets interesting. The slow, psychological shifts happening in the minds of human investors, changing narratives, building FOMO, eventually translate into action. People start buying. This initial wave of human buying creates a signal in the market data. The algorithms see this signal. They see the increase in volume and the upward price pressure. Based on their programming, they interpret this as a momentum signal and they pile in, buying in massive quantities. This algorithmic buying causes the price to shoot up much faster and much further than the initial human buying would have done on its own. What we see on the chart is a sudden, violent price spike, a whiplash. It looks like a purely technical event, but it's not. It's a reflection of a much slower process. It is the end result of a story that has been building for days or weeks. The algorithmic speed is just the final explosive expression of a slow-moving psychological shift. The machines are not the cause of the move. They are the transmission mechanism. They are the hyper-efficient nervous system that translates a collective human feeling into a dramatic, instantaneous market event. The fast technicals are a mirror of the slow psychology. The role of these algorithms introduces a strange player into the market, a player that doesn't think like us, but one we must trade against. Some algorithms aren't just built to follow trends, they're built to create them. They're programmed to hunt for weaknesses in market structure. For example, an algorithm might detect a large cluster of stop-loss orders placed by human traders just below the current price. It knows a small push will trigger forced selling. That creates a predictable point of weakness, a pool of liquidity. So the algorithm may initiate a large sell order, aiming to push price just enough to hit that first set of stops. This is the unseen puppeteer, pulling a string. Once the first domino falls, the cascade begins. Stop losses trigger more selling. Price drops further, triggering even more stop losses. The algorithm that started the mini crash can step in at the panic bottom, buy back at a much lower price, and profit from the chaos. It's a predatory strategy, happening constantly and invisibly down in the market's plumbing. That creates a bizarre, confusing environment for the human investor. They might see the price suddenly plummet, then recover just as quickly. They look for a reason, a news event, a story. There is none. The move wasn't driven by narrative or fundamentals. It was a structural, mechanical manipulation to exploit predictable human behavior. It's like playing a game where another player can see your cards. The algorithms can see the collective order book. They know where fear lives. They know the pain points. This adds another layer of volatility. Price moves aren't always honest signals of sentiment. Sometimes they're artificially constructed. They are traps. That deepens confusion and distrust for many investors. The market can feel rigged, like a game you can't win. You aren't just fighting your own biases or the madness of the crowd. You're also up against invisible, lightning-fast machines designed to profit from your very human, emotional reactions. There is a fascinating part of our brain that helps us understand each other. It involves something called mirror neurons. When you see someone smile, a part of your brain fires as if you were smiling yourself. When you watch an athlete make a graceful move, your brain simulates that movement. These neurons create a shared experience. They allow us to feel what others are feeling. They allow us to empathize. They allow us to learn by imitation. This system is fundamental to how we connect with each other. It's the neurological basis for empathy and for herd behavior. We see, we feel, we copy. Now let's conduct a simple thought experiment. Imagine the crypto market is not a collection of individuals, but a single, vast network connected by these mirror neurons. The screen, the price chart, the Twitter feed, the news headlines, is the shared sensory input for this network. When a trader sees a large green candle on the chart, their brain registers a positive signal. Their mirror neuron system might even simulate the feeling of success and excitement they attribute to the people who are buying. This creates a subtle, unconscious urge to do the same thing, to copy the action. This effect is amplified by the speed and visual nature of modern market data. We are not reading dry reports. We are watching a dynamic, colorful video game of flashing red and green lights. A sharp upward spike is a visually powerful event. It grabs our attention. It triggers an immediate emotional response. Our mirror neuron system doesn't distinguish between a real person celebrating a win and an abstract green bar on a screen representing that win. It processes the signal in a similar way. Something good is happening. Others are succeeding. I should join in. It is an instinctual, imitative response. This is perhaps the deepest level of our analysis. The whiplashes are not just about stories, biases, even algorithms. They are about our fundamental wiring as social creatures who learn and feel by imitation. The market structure, with its real-time charts and social media feeds, has created a powerful digital mirror. We are all looking into this mirror at the same time, and we are seeing the collective actions of everyone else. And our brains are doing what they have always done. We see the herd moving, and our mirror neurons fire. We feel the urge to move with them. We become part of the reflection. So, we have arrived at the end of our journey. We started with a simple question. Why does the Bitcoin market move with such irrational, whiplash-inducing force? We have seen that the answer is not found in any single place. It is not just in the technology. It is not just in the charts. The answer is complex. It is woven from the very fabric of our human nature, amplified by the unique structure of the market we have built. The billion-dollar swings are not a glitch in the system. They are the system, operating exactly as you would expect when psychology and technology collide in this specific way. It begins with a story, a simple, powerful narrative of inevitable riches or impending doom. This story spreads like fire around the digital campfire of social media, powered by the siren songs of influencers and the echo chamber of our feeds. This is the herd forming. Then, our own minds go to work. Our deep-seated biases kick in. The fear of missing out pushes us to buy into a rally. The powerful sting of loss aversion causes us to panic sell during a crash. Our confirmation bias filters the world, showing us only the evidence that supports the story we already believe. We are not rational actors. We are bundles of predictable, emotional reflexes. Into this psychological soup, we pour the accelerants of modern market structure, a 24/7 market that never lets us rest. Leverage that turns small moves into catastrophic liquidations, and lightning-fast algorithms that act as the market's nervous system, translating slow-moving human sentiment into instantaneous, violent price spikes. These machines hunt for our weaknesses, exploiting the stop-loss orders and panic points created by our predictable human fears. The final piece is the digital mirror. Our brains, wired for imitation, see the collective action on the screen and feel an irresistible urge to copy it. This, then, is the anatomy of a whiplash. It is a story, activating a bias, amplified by a machine, and reflected back to a herd. Each element feeds the next in a powerful, self-reinforcing loop. It is a perfect storm of narrative, psychology, and structure. Understanding this process doesn't give you a crystal ball. It won't tell you where the price will be tomorrow, but it gives you something far more valuable. It gives you a map of the territory. It allows you to see the hidden forces at play, both in the market and, more importantly, inside your own mind. Recognizing these forces is the first step. Resisting them is the next. If the market's volatility is a product of speed, emotion, and herd behavior, then the antidote must be slowness, logic, and independent thought. It requires a conscious effort to swim against the powerful psychological currents. It means building safeguards, not just for your portfolio, but for your mind. The path to becoming a wiser investor is not about finding better information. It is about building a better framework for your decisions. It is about creating space for your rational brain to do its work, shielded from the noise of the crowd and the whispers of your own biases. So, here are a few practical safeguards. First, slow down your information intake. You do not need to react to every headline or tweet. Create a decision journal where you write down why you are making an investment, what you expect to happen, and what would prove you wrong. Second, automate your investment plan. Decide on a strategy, perhaps investing a small fixed amount regularly, and stick to it, regardless of the market's mood. This removes emotion from the timing of your decisions. Third, diversify. Never put more money into a volatile asset like Bitcoin than you are truly willing to lose. This lowers the emotional stakes and dampens the terror of loss aversion. Fourth, have a predefined exit strategy for both gains and losses before you invest. This helps you fight the anchoring bias and the gambler's fallacy. Fifth, turn down the volume of the herd. Spend less time on crypto Twitter and Reddit. Deliberately seek out intelligent, well-reasoned arguments from people who hold the opposite view to your own. This is the only way to fight confirmation bias. And finally, the sixth safeguard: embrace humility. Acknowledge the role of luck. Accept that you cannot control the market. This deflates the illusion of control and keeps you from taking foolish risks born of overconfidence. These are not complex strategies. They are simple behavioral changes. They are about creating friction. They are about putting a pause between the stimulus of the market and your response. The goal is not to outsmart the market or to predict the next whiplash. The goal is to prevent the market's psychology from becoming your psychology. It is to look at the madness of the crowd, to feel its pull, and to have the strength to stand still. To watch the roller coaster from a safe distance, with a clear head and a steady hand. To slow down. To think differently. To simply think.